All right. Well, welcome everyone to today's webinar. Thank you so much for being here. My name is Liz Fairclough. I'm co-founder of InvestHer, joined by Paige Buckman, and Mariah is also here behind the scenes, but I'm really excited about having them here about choosing your next funding strategy. And Backflip has been a great partner of ours, sponsor of ours. They were at InvestorCon last year. They're going to be at InvestorCon this year, of course. So really, really excited and really appreciative of the time. And today's all about funding. And I don't know about you, but as an active investor, that is literally one of the most important tools in our toolbox. It's how we're going to get to closing. So thank you for being here. And Paige, thanks so much for being here.
Yeah, of course. I'm so excited. Thank you for having me.
We do these live because we want to engage with all of you and we want to serve our community of InvestHer. So in order to do that, I would highly recommend turn your phone off, be 100% present here, because there might be one thing that you get that can make you $25,000 or help you buy your next deal. And I think that's the value of doing these types of things live. I'm not recorded. I'm not a bot, just in case you want to. Lately, I don't, people I talk to, I'm like, are they a bot or are they not a bot? But we are live here with you. So please ask questions. And as you're here, I'd love to see who's calling in and where you're calling in from. So in the chat box, if you could put your name and where you're calling in from. And if there's something when it comes to funding that is a challenge for you right now, what is top of mind for you? Like, what is keeping you up at night? What is frustrating you when it comes to funding? Because it is a critical part of our business. Obviously, you cannot be a real estate investor and not know what I'm even talking about, right? So I'd love to see where everyone's calling in from. What I love about our community is active, it's engaged, and we're going to continue doing that as we grow our community. So we got some great. We got the East Coast, we got the West Coast represented, which I love. Hey, Bernadette. I don't know where Torrance, California is, but I'm sure it's beautiful and much warmer than Pennsylvania right now. Hey, Mary from Nashville. Great to have you here. Emily, awesome. Hey, Angie from Fort Lauderdale. We're going to be in Orlando very soon for InvestorCon. Morristown, awesome. Well, I'm struggling with funding for a first-time investor. Yeah, Anna, that could be something that is a challenge, right? Because especially for those who you're trying to enroll, they may look at you and be like, okay, this person's a little riskier or their deal's a little riskier because you're newer to it. But I do know in talking with these folks and other lenders, right? Depending on your situation, you might be a perfect borrower as well. So don't let that be something that stops you, but we'll hopefully touch on that today. Angie, I've been working with Paige before on a deal. She's amazing. All right. You're already getting shout outs here, Paige,
Yeah.
which is
Hi,
amazing.
Angie. That's awesome to have you here.
Hey, Christina, one of our Strive members. I'm not sure what kind of funding is available for RV parks. Not only a mortgage, but also growth opportunity to develop. That's a good one. I'm curious to see what you have to say about that. All right, awesome. Very cool. My question's about carrying costs. Okay, awesome. Good. Great that you are all here. We're going to do at least 15 minutes of Q&A. So what we're going to do, I'm going to give the floor to Paige, going to present some strategies, some information, hopefully to help all of you. And then in the Q&A box, if you can, put any questions that you have. And then we will, kind of go through those. But be selfish. Ask for what you need. That's what this is for. You got somebody, you have someone who's able and willing to answer them for you. So you can, again, get the information quicker. So again, excited to have everyone here. Please stay as present as you can. This will be recorded. Pretty sure it's being recorded. Make sure. Yeah, it's being recorded. Okay. And Paige, without further ado, I'll give you the floor here. I'll jump on again about a half hour in, and then we'll go from there.
Awesome. Thank you so much, Liz, and thank you for having me. I'm super excited to chat with everyone today. Bear with me. Let me share my screen real quick. All right. All right. Is everyone seeing my screen?
Yes.
Okay, great. So thank you again for having me. Really excited. I do just want to do a brief introduction. So again, one of
Paige, I'm sorry to interrupt you, but what we see is um double click to enter full screen mode. So it's not, I don't, we just see a black screen right now.
okay, hold on.
Um, just to make sure you're fully sharing. I want to make sure.
Yeah, for sure. Let's see. Mariah, do you think you'd be able to share the presentation? Because it is not letting me.
Yeah, you bet. Let me share.
And while you guys are figuring that out, I'm gonna put a link here in the chat box. So like I said, Backflip is gonna be at InvestorCon. We are planning an amazing conference for all of you. This will be our fourth in persons, June 1st to 3rd. For those who are on this webinar who haven't gotten their ticket yet, would love to have everyone there. We're really every year we take it to a different level, and this year will be the same. So it's gonna be 2.5 days of just transformation. The biggest difference from past years is that every session is going to have like a workshop feel. So women are going to be able to ask questions, really dive into the content. So it feels real, transformational versus it being you're just learning information and not really having an impact in your own life. So really excited about the conference coming up. So make sure you get your ticket. It's just, we're preparing a lot for all of you. So I just want to make sure everyone got that. Oh, you got it on screen. Awesome.
Yes, we are in.
Perfect. I'll stop talking.
Thank you, Mariah. If you can go ahead and go to the next slide. All right, so just wanted to do a brief introduction of myself. I am an account executive here at Backflip. Prior to working in the hard money space, I actually spent almost 5 years in the conventional lending world. So I do have a background in both hard money as well as conventional lending. It has been quite a fun transition. There are a lot of differences between the two, which is really cool. And I am located here in Charlotte, North Carolina. I have such a passion for women in real estate. InvestorCon is one of my absolute favorite conferences. Backflip attends many, and this is always my favorite. So it is very, very cool to meet so many amazing women and just powerhouses in the real estate world, especially with it being such a male-dominated industry. So really excited to be here. If you don't have your tickets, like Liz said, definitely make sure that you are attending because it's a great conference. And then to go to just a brief agenda of what we're going to talk about today. So we're going to go through a real deal analysis use case. The deal that we're going to analyze is a deal that's in my market here. It's in Rock Hill, South Carolina, so near the Charlotte area. Not sure if we have any other North Carolina or South Carolina participants here, but we will go through that analysis. We will look at what our capital tool belt is. So we've got 4 main funding sources that y'all might be familiar with. So cash, bank, what we would assume would be like a conventional loan, a hard money loan, and then a private money loan or a private money lender. So we'll talk about when it's best to use a certain funding source, or really how can you ensure that you're using the funding that makes the most sense for you and for your individual goals, because it's not a one size fits all. What works for one deal might not work for a different deal. So it is important that we look at all of our options and make sure that we are making the best decision based off of what that deal is specific and what our goals are for that deal. So we're going to talk about returns. So what do the returns look like? Again, we'll look at that with our real use case deal analysis, but how do our returns differ from our different funding sources? Are the returns similar? Are they different? What are the pros and cons? We'll also talk about some action items. So moving forward, setting us up for success in finding a funding partner, leaning on our community, finding really what sets us up for the absolute best returns. We're all doing this to make money, but also to make a difference. So what action items can we do today to set ourselves up for success in the future? And of course, we'll end with a Q&A. So this is going to be our deal that we're going to kind of analyze today. We're going to use these real numbers to look at if we were using this deal, if this is a real deal that we are actioning today, what are those numbers going to look like? How do we want to set ourselves up for funding? Feel free to look up the address. This is a real property that I am actually working on for a client now. So feel free to look it up. It's a fix and flip. Again, Rock Hill is about 25 minutes outside of Charlotte. So in a good location, in a great area. And the client that I am doing this property for is eventually going to utilize it as a flip. All right. So these are just going to be our rough numbers. I probably, looking back at this, could have used some whole numbers to make the math on myself a little bit easier, but we're just gonna, I'm just gonna take the challenge today. So 139,000 AIV. So this is gonna be our as-is value. What does the as-is value mean? So this means that we really want to try and purchase this house for ideally less. You've probably have heard the term that, or the saying that you make money on the purchase, or you make money on the buy. So we want to try to buy this house for less than 139,000. But if an appraisal is going to show the as-is value of this home as being worth 139, then let's say we're going to purchase it, just for example's sakes, for 139. And then our ARV. So an ARV is an after repair value. So again, if we're going to flip this house and we're going to put some rehab into it and we're going to fix it up, what does our resale value look like? What are houses around this home going for in the market? What is really our goal to make the most out of this deal and out of this profit and this return? So let's assume that we've walked the property. We've walked the property with our contractor. We want to put in about 46,000 in rehab. Really could have made this easier on myself and said put in about 50,000, but for some reason we really just want to put in 46,000 in rehab. Let's assume that 46,000 in rehab is going to be enough to get us that 306,000 ARV. Just over 300, that's what we're shooting for. And where do we get that number? That number is based on comps in the area. We're looking at recently sold properties on that street, even in this neighborhood. A lot of times when you're targeting a fix and flip property, you want to make sure that there's great comps around. You want to make sure that the game plan that you see for this property is well supported in the market. So with these initial numbers, with our 139 as-is value, our 306 ARV, and our 46 to 50,000 rehab, then we are assuming a net profit of 80,000, 81,000 to be exact. So we can say that this is a great deal. This net profit is going to take into account our closing cost, our realtor cost, our holding cost, and we will dive into that a little bit later on. I just wanted to kind of introduce ourselves to the deal that we're going to be talking about today. All right, so before we get into the numbers, let's look at some key factors that might go into choosing the best funding for your deal. So there's 4, let's call it almost 5, because next page we're gonna have another one. There's 4 big factors that we wanna look at when we are setting our deals up for success, when we're thinking about what is our overall strategy? What is the absolute best way that I can get the best return on this project? So time. I'm sure everyone has heard this saying, time kills all deals, but let's break it down just a little bit further, because time to investors can mean a lot of things, right? So what can time mean? It can mean speed to close. So speed to get the property under contract to actually close on the property. That's what we are referring to when we say speed to close. Speed to complete the project and exit the deal. So overall project timeline, project completion timeline. It could also mean, take it a little step further, it could mean time to receive your rehab money. If you're using a hard money lender, or you're taking draws, or even if you're using a private partner for that rehab money, you're going to want to make sure that you're setting yourself up on a timeline that that rehab money is coming in on a consistent basis. You're able to use that to pay your contractors and stay on track for that overall project timeline. Liquidity. So liquidity is probably what can be the scariest when we think about funding our deals and when we think about how to set our deals up for success. So liquidity doesn't have as many definitions in the real estate world as time does, but it still is multifaceted. So liquidity is how much you have available for the deal, but it also takes into account your holding cost, your monthly expenses. If you're taking a loan, it takes into account your closing cost. If you're using a realtor, it takes into account what that realtor is charging. Liquidity is going to be your overall cash, but your assets for the deal. How are you making sure that you're protecting your liquidity and that you're leveraging your liquidity for the absolute best use cases that you can? So we'll talk about this a little bit further. And then we're going to talk about experience. So experience is essentially your quote track record for prior flips or prior burrs. So some capital partners will look at your experience to determine your borrowing eligibility. I think I saw this in the chat earlier that that can often be a hurdle because how can we gain the experience that we need if we can't get our first deal done? How can we go to these lenders who require you to have, 1, 2, 3, 4 projects before loaning any money? It puts us in a tough spot, and it is kind of a misconception of why a lot of people think that they have to use a conventional loan or they have to have a bunch of cash saved up in order to just dive in and get their feet wet in investing. So that's a real stigma out there. It's a real issue in the industry, and I think that that's something that we should dive into further today for sure, but something that can definitely be a solution. And then your exit strategy. So what's your plan for the property? Is this, is it your first deal and you're not really trying to be a landlord? You just want to flip it and exit it as soon as possible, maybe to minimize your short-term expenses. Or do you want to create a rental for positive cash flow? Do you want to create a portfolio? There's no right or wrong answer. These are all tools and all decisions that are going to set yourself up for future success. It's just how you want to go about your own investment strategy and how you want to reach those goals. All right, next slide.
Hey, Paige, just quick question, and it's something that some of the folks on the webinar might be wondering, is the liquidity question. Is there a rule of thumb? I think that's always something that newer investors don't realize that's going to be important, right? And obviously it varies, but is there a rule of thumb of, okay, I'm looking to borrow $100,000, $500,000. Is there a percent of what a lender is going to want to see from a liquidity perspective so that again, it could be either myself or a partner,
Yeah.
right? Because we could creatively come up with that. But is there a rule of thumb for the newer investors on the call that don't even realize that's actually important to note?
Yeah, absolutely. No, I'm glad you asked that. And we will definitely, I'll kind of break this
Okay,
down.
you'll go over that. Okay, perfect. Sorry.
Yeah, I mean, I'll break it down per capital source. But yes, I would say we'll definitely highlight that. And I think that's
Okay.
a really good question. All right, so I'd recommend taking a screenshot of this. I think this is a really good slide and a really good chart, but this chart is essentially going to be our tool belt for how does each type of capital solve the 5 components of the deal. So that's what I meant when I said there would be a fifth. The 5 components we're going to look at: time, liquidity, experience, return, and exit. So I just went through the time, liquidity, experience, and exit, but return is as simple as it sounds. Return, we're not here to, or we're not doing these deals to lose money. Obviously, that's not ever going to be anybody's goal. So all 4 of these options, cash, bank, hard money, and private money, should, if we're playing our cards right and we're doing the things that we can to set ourselves up for success, lead to a return. So just kind of quickly looking at this chart, and I will dive into each of these a little bit more, but we're going to see just high level rate cash. It's going to save you time. You don't have to get a loan. You don't have to, you don't have to get an appraisal done if you don't want to. You're going to be able to close as quick as you want if you have all the cash. But how many people have all the cash to go buy these houses up front, fund the rehab up front, and not feel like they're draining their whole bank account? So that's where our cons come in. It doesn't utilize your leverage to the full degree if you're funding a deal in cash, because you might only have the capital to do one deal at a time. So you're not leveraging your profits. As you get a little bit more experienced and you feel comfortable taking on maybe multiple projects at a time, or you want to just not feel like all of your cash is tied up in this one project, then loans and hard money and private money and any type of loan can be really beneficial for you. So the bank, again, when I say bank, I'm referring to conventional loans. I'm referring to even FHA 203K loans. That's what we're looping, or that's what we're kind of grouping into the bank. So bank pros, we've got lower interest rates for the most part, and we'll dive into market rates specifically for this deal, but market rates as a whole we'll dive into. It could be better for people that are buying turnkey properties. So if you aren't rehabbing a property, or you just want to buy an investment property and you want to keep it as an investment property, and you're not necessarily as worried about any rehab money, or you're not worried about like your borrower verification, so you've got a great credit score, you've got the income to show that debt to income ratio that you're going to need when it comes to a conventional loan, then that might be something that you look at. But the cons of a bank, we already talked about some of them, but lengthy closing processes. So 45 days to close, I mean, honestly, at a minimum, not great for liquidity. So could use a higher down payment, 20 to 25% at a minimum for a bank, 25% at a minimum for investments. So that's a big chunk of change. And then it could be tougher for those of us who maybe we don't have a W-2 job. We work a 1099, or we carry other debts that kind of accumulate on our debt to income ratio, and we can't on paper show all of that liquidity that a bank is going to need. Hard money. So hard money and private money I'm not going to group them together because they are different, but they will have some of the similar pros and cons, and we can always dive into really the main differences between a hard money lender and a private money lender. But pros of hard money, you've got a quick close. Most hard money lenders can close in, 10 to 14 days, sometimes less. You don't need the experience. Some hard money lenders will ask for, one prior project, but there are a lot of hard money lenders who are there to really help get beginner investors started and help scale their business. So experience. I think we lost it. Okay, got it. The credit range is more flexible for hard money. We can be a little bit more flexible with underwriting guidelines. Great for deals that are expected to have higher profit margins. You can do a higher volume of deals. You can take your cash further if you're using a hard money lender or a private money lender. And that's why a lot of people look for great relationships with hard money, because it allows them to take the cash further than if they're just tying it all up into one transaction. Some cons of the hard money: it could be more expensive. Rates are notoriously higher for hard money or even private loans, because they're not market rates. So they could be a little bit higher because you aren't going through the same underwriting process that a bank might do. They're shorter term, so 6 to 12 months, sometimes 24-month loan terms. So you do have to have a level of confidence, right, that deal is going to be completed, that you're going to exit the deal, or that you've got a solid refi plan in place. So you've got to think about the exit, which is why I have that little squiggly line there under hard money and private money, because that is something that requires just a solid exit plan. And then private money, I'd say the pros are all similar to hard money. There's less of a, I'd say, real strict underwriting process in place. It's easier, it's more flexible. But the cons of private money are there too. It's hard to find. It's really hard to find a private money partner. You have to have the experience, you have to have a track record there, so that you can really show and vouch for the project that you're doing to your private money lender. Private money is not regulated. So, I mean, it could be anyone that could be a private money lender. That's already taking on a level of risk there, right? That could go away. They could ask for more money in the middle of a deal. You could, your private funding might go away without any warning. There's just no standardization in those terms. So every deal is going to be a little bit different. The loan documents are going to be a little bit different, and private money can just have a different level of return. So that's always something that you want to be a little bit cautious about when you start getting involved with private money. We can go to the next slide. So I'll go through these pretty quickly, but this is essentially just, I already highlighted most of this, but this is essentially just saying, to wrap all of that up, if we were to say, who's cash best for? If you have high liquidity and you aren't planning on doing a ton of volume, what are the challenges? You've got to save a lot of money. I mean, I think if we could do all the deals, all of us, in cash, then I think that would be great. But the challenge is getting that cash, and then risking that cash. When you're not leveraging the properties, you're not leveraging your deals, you're risking a lot of money when you do a home or when you do a project all in cash. Returns. So you're going to maximize your gross profitability, which is great. You're not going to have any financing related closing costs. You're not going to have a monthly payment. Obviously, if cost of capital is going to be the most important thing to you, then cash could be a really good option if it's available to you. Moving into the next one. So bank. Who is the bank the best for? So this is going to be your W-2, like high income, high credit, high liquidity. It could be best for turnkey rentals. There's a lot more products available for turnkey properties versus rehab properties. There is a lot more challenges when it comes to rehab properties and you're using a bank. The challenges of a bank. So you've got asset-based underwriting, you've got borrower-based underwriting, you've got a long timeline to close. I'd say 30 to 40 days might be a little bit generous. It's been a while since I've been in the conventional space, but it's probably a little bit generous there. And then draws for rehab. If you can find a conventional loan that even has draws for rehab, it's going to take longer too. And then how do the returns look? So solid profitability when it comes to lower carrying costs, lower capital costs. The interest rates are going to be lower than they would with a hard money loan. So your returns might look a little bit better on paper. And again, we'll dive into that with the example that I shared earlier. Hard money. So who is hard money best for? Investors of all experience. There can be a beginning product for hard money for beginning investors. All levels of liquidity, all levels of credit, really the investors that are looking for that level of flexibility. What are the challenges of hard money? More expensive. Closing costs could be more expensive. Carrying costs could be more expensive. And that refi risk. If we're taking too long for the project and we're running up against a 12-month loan term, or if we're just over leveraging our projects, if we're, a hard money lender could fund up to 96% of a project, and all of a sudden you don't really have a big stake in the deal. So you run the risk of over leveraging. And then how do your returns look? I mean, this is going to be dependent on the use case, right? But you're able to maximize that leverage. You could do multiple deals at once. $50,000 could allow you to do 2 different deals versus not even enough if you were to spend $50,000, not even enough for a full project on another deal. So those returns can look very good on paper, and they can also allow you to leverage your investments. And then private money. So who is private money best for? It's going to be best for experts. For private money, you're going to have to find a partner that you really trust and that really trusts you. So that's the challenge right there, is finding that partner, educating that partner on the best way to put the deal on paper, making sure that the private money lender's capital commitment is not at risk, right? It has to be a mutually beneficial relationship. So we have to think about how that risk is managed. And then how do the returns look? Similar to hard money, these returns are going to look almost the same, assuming that everything goes smoothly with the deal itself, and you don't end up over leveraged. All right, so going back to our scenario on State Street and Rock Hill. So in other words, this gross profit is going to be our ARV with our cost basis. So if you remember on my earlier slide, our profit was around 80,000. That's taking off your holding cost, your realtor costs, staging, cleaning, things like that. So I just want to bear in mind that these are your gross profit numbers, just really for simplicity's sake. And I won't get too nitty gritty about this. I'm sure the presentation will be shared, so we could always dive into this further at a later date. I absolutely will be happy to do that. But I just want to briefly talk about, and this addresses Liz's question as well, what the rate, fees, monthly payment, holding cost, loan to value, loan to cost, what that looks like. So the LTC, which means loan to cost, or the LTV, which means loan to value. In other words, this is going to be how leveraged is the property. So how much of the property's value are we taking a loan out on? So in other words, how big is our down payment? How big is our initial stake of equity in the property? So this ties back to liquidity. Everything ties together. This ties back to liquidity and how much cash you have available up front for this deal. So if we're looking at a bank, at a conventional loan, then we're going to end up looking at about a 25 is a good rule of thumb down payment for a investment loan. So 75% of the property's value is going to be leveraged. And you're going to be likely expected to bring about 20 to 25%, sometimes more, depending on outside factors, to the deal. Hard money and private money, typically, and again, there will be no one size fits all, but typically you're going to end up at around 90% leverage. So that looks like a 10% down payment. It can be a little bit different depending on, the different profit margins, the as-is value versus the after repair value, and anyone who's interested and kind of diving into these numbers further, I'm happy to work with you on that as well. But I'd say a good rule of thumb for a hard money loan, anticipate, I'd say anywhere from 10 to 20% down within reason. So we've also got our rates and fees. So these are based off of the market rates right now. So we've got our conventional rates at 8.5% for an investment loan. Honestly, I was probably feeling a little bit excited and went a little low on the fees. So just bear with that in mind. But I'd say about 2% of the purchase in fees for a bank, and so on and so forth for hard money and private money, right? So hard money, we've got about a 10.5 rate for the industry standard. That might be a little bit lower for some lenders, a little bit higher for others, but 10.5% we'll say is our industry standard rate for hard money right now, typically between 1.5% to 2% on fees. So that can include origination fees. It can include underwriting, legal fees, appraisal fees. And then private money, the private money is really going to set their own rates, set their own fees. This is what I typically am seeing in the market that I'm currently in, but also just in the industry as a whole. I typically see private money between 9 and 10% with about 1% in fees. But just bear in mind that private lenders do have the ability to set their own terms, set their own fees, and kind of use that on a deal by deal basis. And then from those rates, we've got our monthly payments. We've got our holding cost. Our holding cost will be our monthly payment. I did a 6-month hold here, so monthly payment times 6, and then our origination fees. So you can see where that profit kind of comes from with the 121,000 gross profit of cash. That's just our 306 ARV minus our total cost basis of 185,000. That's where that 121,000 is coming from. And then you can see once we take away those holding costs, where the profit lands for banks, hard money, and private money. The biggest thing that I want to call out here is that you'll notice banks, hard money, private money, they all have similar profit returns. So this isn't a huge difference, right? Like you're seeing a profit return within like a $5,000 difference. So seeing that these all have similar returns, that's why we really want to think about how to set ourselves up for success in the beginning, because we have to keep in mind that while the returns come out similarly, if you do that same transaction with a bank, then you just spent 20% more in a down payment up front. So while you might end up making the same amount of money back, the difference is in how you can really get started and how you can set yourself up for success in the beginning of that deal to make sure that you're putting your money to work, that you're not spending all of your money to make essentially the same amount of profit that you would make if you did utilize a hard money lender or a private money. You're going to end up with a similar result. Next slide. All right, so I spoke a little bit at the beginning about action items, and I've said it probably 10 times. I've heard myself say it often about setting ourselves up for success, but I really want to just kind of drive this point home that the best action items we can do is vet our partners, lean into your community. You're all here because you're interested in relationship building. You likely attend conferences, you attend meetups. That's really the best thing that you can do to find the best partners and find the professionals in your industry who can refer you to the best partners. Ask people who they use for their projects. And this can go for lenders, it can go for contractors, title companies, realtors. It can really be every aspect of the deal. Ask for references. Don't be afraid to interview the people that you choose to work with. And know that your goal here is to build a trusted team. You want to have a team of people with your lender, your realtor, your attorney, your contractor, and even if you want, to have a mentor and just somebody that you can lean on and talk to. I just can't say enough how important that community is, and something that I'm very passionate about as well. All right, so that will conclude my presentation.
Awesome. We got a few questions, and do you and please post, I'd love to encourage anyone else to post some questions. There's a lot of good points you're making around you're hedging your time against money, against like almost like the business plan, and seeing what tool in your toolbox is going to help you get there. So cheaper money doesn't necessarily mean it's actually going to be cheaper in the end. More expensive money doesn't necessarily mean it's going to be more expensive in the end, right? And I think as investors, right, we're in charge of putting the deal together. So I think that's always important. So I'd love to see any specific questions. Before I do that, I would love to give you, Paige, just give a shout out to how you serve our community, how you help our community, and what that looks like, if you can. And you could put that's obviously how to connect with you. That might be the best approach. But yeah, just share a little bit about what Backflip does, so everyone on the call knows.
Yeah, no, I'd love to. So Backflip is a hard money lender. So if you notice me being preferential towards any of those options, that might be why. But we are a hard money lender. We are very, very big on community. So I mentioned I'm in Charlotte. I have monthly networking events here in Charlotte, but we do that in a lot of key markets around. So we really, really lean on our community. We have a great community of investors. We love to meet all of the people that we work with. We attend many conferences as well, so we will be at Investor. Aside from just being a hard money lender, though, Backflip does have a free app. I believe if you scan this QR code, it might take you to download our app. But free app, you can use it to analyze your properties. It gives you free access to the MLS, so you can pull comps. You can apply for a loan right through the Backflip app. It'll come to me. I'll build out a term sheet for you, and then I'll be a partner for you throughout the whole process.
Okay, cool. Awesome. All right, so let's get into some questions here. Felicia, I'm going to manage your question, and then I'll go to the Q&A box. This is great. So that's good to hear. In terms of liquidity, using the deal that you just analyzed, what's the amount of money you would expect the borrower to have outside of the down payment?
So that's going to be what your holding costs are on my chart earlier. So I would look for, you've got to have, I'd say 10% for a down payment. You've got to have at least 1 to 2%, depending on the deal, your experience level, your credit, for fees. So origination fee, appraisal fee, attorney fee, and then I like to say another 1 to 2% for third party costs. So that's like your title cost, your insurance for the property. So I'd say really all in, and this is going to be very deal specific, but I'd say all in, you want to look to have around 15% comfortably, if you're putting 10% down.
The other thing that when people are putting money together, like a HELOC or they're doing 100% construction loan, they sometimes don't realize they're going to have to carry the interest payments,
Yeah.
right? It seems obvious, but they sometimes don't factor that in. And as you go higher, like especially if like it's a luxury flip, or
Yeah.
that number could be $25,000 a month, right? That could be a significant amount in interest. So
Yeah.
don't ever underestimate interest, and always look at it conservatively. So especially if it's not just your own cash per
Yeah.
se. We recently put together a project and had a few different moving parts, a partner, our HELOC, we got really, creative, and our own cash. And just putting that number together, that
Yeah.
really is a motivator to get the project done. Because I know how much it's costing us. Literally just not even like other holding costs, but it's really just the interest can really be probably one of the biggest line items for people right now. So
Absolutely. Yeah, and it ties back to like looking at how time can play a factor into these deals as well.
absolutely.
They go hand in hand.
Something I would recommend everyone on the call to do always is, before you make that offer, run your worst case scenario with two things in mind: the time and obviously the money that it's going to cost you to do the deal. And so when you play with those two kind of components, kind of like you're saying, Paige, okay, this took me 18 months, it's supposed to take me 12 months. It's going to cost, I think it's going to cost, my estimate's 250.
Mhm.
Gonna cost me double that. Like, get like aggressive, not crazy aggressive. I don't want you to kill deals that don't need to be killed, but playing with that and see, okay, what can we live with? I
Yeah.
always like to get to the point where when I'm analyzing worst case scenario, um, what is my time and money break even number? Literally, if I make no money and I'm just breaking even, which I don't want to do, what is that time and what is that amount of money I'm putting in? And am I pretty confident I can beat that?
Yeah.
And that's what you're hedging right now. And I see people all the time, if like the stars align, I make $20,000. Like, that's not right now. That's not the times we're in. You have to be conservative, right?
Yeah.
Because of just different elements of what's happening out there. So I'm a bigger fan of being more conservative right now
Yeah.
than not,
I
as an investor, right? Let alone as a lender, right? You want to do the same.
Absolutely.
Cool. Let's manage this question. I'm a newer investor. I'm wondering about doing a fix and hold as an STR. I would need a loan to purchase and repair, and then I think a DSCR loan to kick in after the renovations are complete. Is this too much for me to handle, or should I just take it one step at a time? It's a great question.
That is a really good question. You're correct in thinking that you'd get your initial acquisition loan to fund that rehab, fund the acquisition of the property, and then you can refinance that into a DSCR loan once that rehab is complete. DSCR loan is going to allow you to get a much lower interest rate than you would on a hard money loan for the acquisition, and allows you to manage those the holding costs a little bit better, and it's going to actually be determined by how much income that property is going to make. I think the second part of the question was, would this be too much? You're asking somebody who is going to tell you to go with like what you feel is your best case scenario, right? Like we just said, like Liz was just mentioning, like, be conservative in your analysis. Think about what is the worst case scenario. Is the worst case scenario that you fix up the property, you decide like, oh my gosh, I don't really want to hold a rental, I don't really want to manage a rental, and you sell it to another investor or you sell it to an end buyer. You've right there, you've crossed off that hurdle of taking the leap and getting into the investment space. And you're not signing yourself away for one property if you're doing it in a smart way. So that would be my 2 cents, but I think every person might have a different answer for that.
Yeah. And I think you want to, people always get enamored with the actual strategy, like the STR or this or that. Again, what we can control is the deal itself. What we don't control is the market.
Yeah.
And in general, newer investors spend so much more time on analyzing the actual property than they do the market itself. And so really lean into, is that market that I'm looking in ideal for STRs? And I know it seems like an obvious point, but I can't tell you how often people don't know those answers. And then they get into things that they probably shouldn't have gotten into, not because the deal or the property, but the market. So you want to be like the palm of your hand, know the market, the ARV, what's happening in the market, economic development. Are people coming in the market? Are they leaving the market? What's happening with insurance? I got a quote for insurance on my property recently for $40,000. It's a single family home, right? So obviously I didn't go with them, but my point is that insurance is playing a big role in investors' landscapes right now.
Yeah.
So again, all those things to be considered, that's market dependent. So really know your market, obviously know your property, and then know the strategy which to use, STR, MTR, long-term hold. But people don't spend enough time knowing the market, and then they wonder why their property's going south.
Yep.
So, and really don't rely on yourself, is that you don't need to know of it all, at all, but who are the people around you? Talk to the lender, talk to the insurance carrier, talk to the broker. They know what's happening. They know what areas to go after and what honestly areas they're not even lending in because of those reasons. So don't talk to Paige when you need a loan. Talk to these folks before you need a loan as part of your team. And so because if they're not looking to loan money on the deal, it may not be a good deal, right? They're lenders. They're trying to mitigate their own risk. They don't want to loan on deals that don't go well. So that's just my opinion about all lenders and insurance carriers. Talk to these folks before you need them.
Yeah.
All right. Another question. Could you list the different types of loans loans today, like construction loan, DSCR loan, explaining quickly the differences? Sure. That's a good question. Like what overall could be some loans that you're lending on in terms of like kind of have an appetite for?
Yeah. I'll kind of speak industry standard, right? I think construction loan is going to be your ground up construction. So you're buying land and you're building something. You're building something from the ground up. That's going to be what ground up construction is for. Backlip is actually not currently doing any construction loans, but I do have some really great referrals. So reach out to me even if that's something that you're interested in. If I know a lot of people, I can connect you with some good people.
Paige, can I mention something really quick? There's even a difference between new construction and like ground up, meaning like not ground up, but like new construction compared to like a heavy renovation.
Yeah.
So be mindful of, are you literally, there's nothing on the property itself and it's brand new construction, or are you tearing it down to the studs, using the foundation and building up? Those are, in the lender's eyes, are very different projects. Insurance, all of the above. So be mindful of the language you're using.
Yeah, good call out. For sure.
Sorry.
And then I will say DSCR loan. So that is going to be your long-term hold. So DSCR, a lender is going to look at how much income could that property make, whether that is a short-term rental, a long-term rental, what income on a monthly basis is that market carrying, and how, like Liz said, how dependent on the market is it, and how protected are you that you are going to make a positive return with that monthly flow, enough to cover the payment of a DSCR loan, to cover your holding costs. And then we've got fix and flip loans. So that's it's really our bread and butter. It's going to be your acquisition. You're buying an already existing property. You're wanting to leverage that property, complete the rehab, fund your rehab. We fund 100% of the rehab, fund the rehab through that loan, and then exit it either by selling it as a flip, selling it for a higher profit margin than you bought it for, or then refinancing it into that DSCR long-term loan, and holding the property as a rental.
And then there's just one other question. Is it future income or current income for a DSCR?
It's potential income. So it's future income based off of the market trends.
Yep. That's important. And that's, how you should be running your numbers always. What is and what it could be, but obviously mitigating your risk, all things consider. The other thing that I would recommend right now is when you're talking to lenders, and if they're like, yeah, I don't have an appetite for that, ask them why.
Yeah.
And to your point, I mean, I'm doing new construction. Other folks are doing new construction. It's not like new construction's bad. You're not lending on new construction. Totally makes sense. But it is interesting to know why certain lenders are loaning in certain ways.
Yeah.
They have an underwriting team. So these are all things that just not just sway you one way or the other, but just consider and understand. So that way, what to bring this type of lender versus another lender. And you want to have variety of lenders, right? Different lenders have different appetites for projects, not just projects, but geography. So you want to know where they're anxious to do more and where they're looking to stay away, especially with all the craziness in our nation of different natural disasters. So, all right, last question, then I'm going to wrap here. And please, Paige, share with everyone on the call your information again one more time. I think, what's great about Paige and Mariah and Backflip is that they're part of our community, right? They're not just coming to InvestorCon to talk about Backflip. Of course, they're going to be representing the company, but they're part of our community. And so they're here as resources and support. And I think that's really important to note, as we continue here. But Stephanie just asking, if we go through hard money lender, is there a potential no limit? Is there potentially no limit to loans equal the deal as opposed to DTI criteria in a conventional loan, correct? She's asking.
Yeah, so I think you might be asking, like, there's no limit as to how much you could purchase, whereas on a conventional loan, okay, so on a conventional loan, you might be limited to a certain amount based off of your monthly income. So you're correct in that sense. We aren't looking at your debt to income, whereas we're looking at how much monthly debt do you have and how does that offset your income coming in. That is not the case for hard money. Hard money is going to look at your total liquidity. So if you're taking on obviously a bigger purchase, then you might need a bigger down payment. And we need to see that you can cover that down payment. But that's really the extent of how we're looking at your eligibility and your liquidity. We're not looking at your tax returns and your pay stubs.
And again, Paige just put her contact info in there to follow up with. Highly recommend. I love to get lenders lined up before I make an offer. So I really have the relationships going, and I know who to go to and who has an appetite for what, versus I got a great deal and now I got to go scramble to get a lender, right? And this could be the way you build a relationship and keep working with them. So Paige, thank you so much. Mariah, thank you so much for taking your time and being on today. Excited to see you both in person, June 1st to 3rd for InvestorCon. And thank you everyone for being on. As we wrap up here, share one takeaway that you're going to do as a result of today. You've just invested time, just invested your energy, your focus. The worst thing you could do is literally go on to something else in your day and forget that you were even here. That would have been a waste of my time. That would have wasted their time. And what we stand for with the investor community always is learning, community, and then literally taking some action, because that's what's going to move the needle. It always moves the needle. One small action to progress your journey as an investor. That's what we stand for. That's what we're all about. So I'd love to see some takeaways, one specific action step that you're going to take away here as a result. Anna, I'm going to run the worst case scenario on my deal. All right. Don't get depressed, Anna. And then once you do that, Anna, post it in the investor community in the Facebook group and ask for help, ask for insight, right? Don't do it alone. That's why we have created a community. That's what we stand for. So I love that. Signed up for Backflip app. Awesome, Rebecca. Thanks so much you're very welcome. All right, cool. Well, thanks again so much for being on. Do something with what you learned. This will be on our blog page as a recording as well. And we'll get this to Kate. I would love a webinar on lender favorite markets. Yeah, that's a great idea, Kate. We'll have to work on that. I think I would love to do something with a lender and insurance agent.
Yeah.
Creating a map and going over every single geographical market, right?
Yeah.
I've already had that idea because I personally need that because I'm like, okay, what area do I need to stay away from so I can
Yeah,
avoid a
it's hard to keep up with
$40,000 insurance? But anyway, thank you so much for being on. I appreciate the suggestion, Kate. And thanks again, Paige and Mariah.
Thank you.
All right, everyone, have a great day.